Hello everyone, I'm Leo Resende. I'm a certified public accountant.
And I'm Brian Barbosa, an international tax accountant here at Leader Associates.
The topic of our video today is FIRPTA, the Foreign Investment in Real Property Tax Act, and its potential filing requirements. When a foreign person is selling U.S. real estate, it's important for them to understand FIRPTA and its requirements. Brian, what exactly is FIRPTA and why is it required?
FIRPTA is a U.S. tax law that requires a foreign person, whether you are an individual or an entity, selling U.S. real estate to withhold 15% of the sales price and have it remitted to the IRS. It was enacted to ensure that foreign investors selling U.S. real estate do not avoid paying U.S. income tax. Now, the IRS makes sure that this amount is withheld and remitted by putting the obligation and responsibility on the buyers. Therefore, if the withholding was required and was not done so, the buyers would be responsible for the 15% withholding tax.
Wow, so this applies to any real estate transaction involving a foreign seller. Even if the buyer is a U.S. resident, they may still be liable for the 15% withholding tax. Brian, when is the time to send the 15% tax to the IRS, and is there any way to reduce or eliminate the tax at all?
FIRPTA must be withheld and remitted to the IRS within 20 days of the closing date or the sale date. And yes, the 15% can potentially be reduced. If the buyer is planning to reside at the property as opposed to renting it out, and the sales price is between $300,000 and $1 million, the 15% can be reduced to 10%. Also, if the sales price is less than $300,000 and the buyers intend to use the property personally, the 15% can be removed entirely. Now, in both cases, a personal use affidavit would need to be signed by the buyers showing their intent to use the property personally.
That's great news. And if there is a withholding requirement, is there any way that the seller can get his money back? It would seem a little unfair that the seller would pay the tax on a property that's being sold at a loss.
Yes, sellers may receive a full or partial refund when they go to file their U.S. tax return reporting the sale. This is actually how the IRS ensures that foreign sellers file the required U.S. income tax returns. Of course, the refund amount, if any, will depend on the gain or loss on the sale. Now, if the seller does not want to wait that long, that is, until the next year to file the U.S. income tax return, there is other options available, either via withholding certificate or application for an early refund. However, we'll cover this topic some other time.
Thanks, Brian. It's important to mention that both the buyers and the sellers will need a U.S. tax identification number. If either party does not have a U.S. tax ID, one will need to be applied for with the submission of the FIRPTA filings.
Here at Leader Associates, we are experienced with FIRPTA filings as well as other international tax matters.
We'll be more than happy to consult and discuss any possible FIRPTA filing requirements you may have. Please be sure to subscribe to our YouTube channel and follow us on our social media pages.
Thanks for watching.